Zero DTE options have become highly popular with day traders over the last few years. They are very risky, but the reward they offer is truly astonishing. In this video, I will give you 3 best zero DTE options trading strategies I have seen in the stock market so far. Implement any of these strategies and be a profitable trader. Zero DTE options trading. Strategy number 3, the credit spread strategy. Following this strategy, you will have money coming into your account the moment your option trade order is fulfilled. The process begins with a market bias. If you believe that a certain stock will go up, you will trade a put credit spread. If, on the contrary, you believe that the market will go down, you will trade a call credit spread. Let's say it is Friday morning, and you are getting ready to trade Apple options expiring that day. Apple is trading at $205 per share. You believe by the end of the session, Apple will not rise above $210. You will sell a call at the strike of $210 at $2.40. In case you are wrong, you want to limit your risk by buying a call at $215 strike price. Since $215 is far away from the current price of the Apple stock for a day of trading, its option price will be cheaper, for example, 60 cents. Now let's see how this may affect your cash flow. You collect a premium of $240 for selling one contract of Apple at the $210 strike. Deduct $60 that you pay for buying the $215 call from that. Your net income is $180. If Apple does not reach $210 or above by the end of the day, both of the option contracts will expire worthless, and you will keep 100% of the premium. If you are not right in your market bias, if Apple indeed rises and crosses the $210 mark by the end of the day, you will first lose your premium $1 per point, and your actual loss will begin after Apple crosses over $211.80 per share. The possibility of that happening is very slim. Not many times Apple rises more than $5 a session. You can do the opposite if you believe Apple will rise in value. You will sell a put option first and then buy a put option a few dollars below. You will receive a premium for selling the put, and the difference between that and whatever you pay for buying the second put is your profit. If Apple does not fall below the strike price of the put you sold, both of the options will expire worthless, and your premium will be your net profit. Zero DTE options trading. Strategy number 2, the Iron Condor strategy. For this strategy to work perfectly in your favor, you need to choose a stock that moves sideways. You first find the range of the stock and sell a call option above it and a put option below it. To limit your risk, you also buy a call option and put option beyond the previous call and put. For example, SPY is trading at $505. The ETF is trading between $500 and $510 for a few days now, and you want to trade an Iron Condor on it. You may sell a put option at the $495 strike price and a call option at the $515 strike price. You collect premiums from both of the trades, but you also want to limit your risk by buying a put option at the $490 strike price and a call option at the $520 strike price. All these 4 components will make one option trade when you use your trading platform's strategy builder. Let's see how this all affects your account. You collect a premium of $165 from selling the put option and $135 from selling the call option. In total, you gain a premium of $300. On the other hand, both the put option and the call option you buy cost you $90. Your profit from this strategy is $210. If SPY ends the day at any price between $495 and $515, you keep all the premiums. all of the options contracts you bought or sold will expire zero. The Iron Condor strategy is the safest strategy for you because a stock cannot rise and fall at the same time. If it rises or falls, you will win the opposite leg of the strategy. Your risk will begin only after all the premium you have received is exhausted. That may not happen every time you trade SPY because the ETF is not that volatile, at least for now. Zero DTE options trading. Strategy number 1, the calendar spread strategy. Let's use SPY again as an underlying asset, and SPY is trading at $505 per unit. A calendar spread would be selling a put or call option that expires today at the $505 strike price, and at the same time buying a put or call option at the same $505 strike price but with an expiry date of tomorrow. Let's see how it affects your cash flow. The premium you collected by selling the call option at $505 was $80. That is your gain. At the same time, you bought a call option expiring the next day that cost you $180 per contract. The actual amount that went out of your account is $100. If the price of SPY rises through the day, the call you sold will hold some intrinsic value, and so will the call you bought. But the difference is, the call you sold will expire today, while the call you bought will hold its value until the end of tomorrow. Since these are cheap options, a little move upward in the price of the SPY will double or triple the price of your call option. In case the ETF does not move at all, or falls violently as it happens during a recession or flash crash, your maximum loss will be $100 that went out of your account. You have not made a profit, but you have reduced your loss by selling a call in the first place. You can do the same by selling a zero DTE put option expiring by the end of the day, and then buying a put option that expires the following day, both at the same strike price. In calendar spreads, your risk is low, but your gain may be really high. If the stock does not move at all, the zero DTE option you sold will expire worthless, but the option expiring the next day will still hold some value. If the SPY moves 10 points the following day, your $100 investment will have $1,000 worth of intrinsic value. That is really a massive gain. There you have them, the 3 best zero DTE options trading strategies of all time. Explore the strategy you like, learn its ins and outs, master it to the fullest so that you never have took for another strategy again. Learn it so well that you never run out of money. I use Interactive Brokers to trade options. They are a global company with an award-winning trading platform. Their trading fees are very low, and compared to other competitors, their margin fees are the lowest in the industry. You can earn a maximum of $1,000 worth of Interactive Brokers shares free by opening a trading account with them by using my unique link. You can implement all the best options trading strategies I have discussed today on their trading platform. I have also made a video about how to prepare the Interactive Brokers platform Trader Workstation for trading. Remember, if you don't have a lot of money to trade with, you can still earn big in the stock market. You just have to have the right tools and expertise. Interactive Brokers and a deep knowledge of trading options may be the way for you to move forward.